Hello and welcome to the first part of our tutorial recording. We will be covering chapter 18 today. So essentially chapter 18 is going to be the last segment of our tutorials for FIN3034. To begin with, let's look at the overview of the past tutorials and the outline for what we will be discussing for chapter 18. So in the overview, the first group is chapter 1 and 17. The second group is about foreign exchange market 5, 6, 7, and 8. The third group is about exposure management, forex exposure management 10, 11, and 12. And the final group, or the fourth group, is 13, 14, and chapter 18. Now, chapter 18 is about multinational capital budgeting and how companies who invest in overseas projects, how they need to look at capital budgeting decision making in order to make sound capital budgeting decisions, right? So, in theory, we will look at the complexities that are associated with multinational capital budgeting, meaning the added challenges that companies face in addition to domestic capital budgeting. What are the marking indicators or the decision making factors? And finally, we will look at the application. So, if you've looked at the lecture recordings before this and if you've listened to it carefully, I've clearly mentioned how this chapter is going to be focusing more on the application side. However, it's good for us to know a few of the elements that can be brought up in terms of the theoretical overview. So the first thing that we will be looking at is the complexities. What are the factors that add complexity in a multinational project? The factors can be broadly outlined under cash flow factors and under managerial expectation factors. Okay, so the first thing that cash flow factors, or the first characteristic that makes it a little complicated for firms to manage multinational capital budgeting, is how to distinguish parent cash flows from project cash flows. So, this how is very important to understand how to distinguish it, because whatever that the project is making has to be looked at independently, right? In terms of if the project is viable or not. The second cash flow factor is parent cash flows often depend on the form of financing, right? Parent cash flows, meaning when they are deciding to invest in a project, they will have to look at how to finance the project, right? So it's very important to separate out cash flows from financing decisions as in terms of operating decisions. It's important to look at the operational part of the money versus the financing, the source part of the money. However, very often this distinction between financing decisions and operating decision is a muddy area, right? It's not very clear. So, in that case, it must be very, very important to understand any hidden charges that need to be taken into account in the cash flow statement. Hidden charges like import duties, hidden charges like any fees for licensing, all of those have to feature in if they are directly linked to that project. Hidden charges like servicing the debt, right? Those have to come into play. The third point is about additional cash flows, any additional requirement that may come into play in that investment. How do you take that into account? What will be the net result when there are additional cash flows? So these are factors that have to be taken into account. Any additional investment, how is that going to be attributed? Is it going to be coming in from the parent entity, or is it going to be from reinvestment purpose from the project. So that's again very important to determine and clarify. The fourth point is in terms of remittance or returns. It's very important to distinguish the inflows and the outflows. How much of the profit that the project generates is going to be returned back? What is the impact of tax on this return, right? Are there any legal or political constraints in terms of movement or funds? This again brings us back to blocked fund situation, right? All of these things have to be taken into account. Any additional non-financial payments. This again links us back to point 3, where you have to take into account any hidden charges that may be accounted for in the project, like license fees, payment for imports, and so on. Now, the second category of factors that contribute to multinational capital budgeting complexity is managerial expectations. Are managers expecting, right, anticipating or expecting any difference in the exchange rate, right, because of inflation? Are they expecting any difference in the debt service charges or interest rates because of the economic impact on that servicing or sourcing of the loan? Because of this, they must create a buffer, right? They must create a buffer to anticipate any unexpected exchange rate changes because of the duration of the project, any possible direct effect that may impact the cash outflows or the inflow of the project. So, in a way, managerial expectation is to keep your returns to a very minimal and then decide if you want to still go ahead with the project or not. Be realistic about your cost, but at the same time, you must ensure that you are expecting minimal returns. Anything over and above your base minimum is always an added advantage. The choice of capital market. Is your domestic market segmented? If yes, then how are you going to create the sourcing, right? How are you going to source capital? If it's not segmented and the foreign market where you are investing is segmented or small, then what will be the impact on your cash outflows? Will you be able to remit back enough money to your parent entity? So these are the impact of market segmentation that can be attributed or may have an impact on the project cash flow statement. So it may also have an impact on the parent cash flow statement because, as I mentioned, if the market is segmented, the government may impose restrictions on the cash outflow. The company may have to incur additional charges, additional financial cost in the event that they need additional working capital. So, this kind of due diligence has to be undertaken by the management before embarking on the project decision. If you decide to borrow from the host market, wherever that your project is going to be placed or located, then how do you take into account the cost of borrowing, the WACC? Do you have to follow it on an international CAPM model or do you follow the domestic CAPM model, right? So that's again one decision that the company has to take. What about the beta or the market return index variability that it will have on the loan? Managers must also take into account the political risk or the stability of the policy, right? Stability of the policy in the host market as well as the domestic market. Is there going to be an upcoming election or a change of hand in leadership that can have an impact on the cash flows, because political risk definitely has an impact on foreign exchange movement. It creates uncertainty. Final thing about management expectation is terminal value. This is always a very important attribute. When companies embark on a project, they're expecting the market value or the handover, right, the sale value, to be adding to their inflows, right? Unless, of course, the project runs long enough and it doesn't have any salvage value associated to it. So, how should you estimate the terminal value? It will depend on the firm's due diligence or investigation on which industry type is the company located in. Is it a public sector or a private sector? Having different perspectives on what are the relevant market values that the company's competitors may have received in recent times of a similar project, right? So these are some of the things that the company has to do or think about before they start their journey on a multinational capital budgeting context. These factors are called complexities because they are absent to some extent when you are looking at a domestic project, right? The scope is, of course, a lot more limited in a domestic project. It also means when the scope is limited, the returns are very limited, right? So, in a way, you can say it's a vice or it's an added necessity that if firms are seeking growth, they have to embark on the multinational capital budgeting journey. And before they decide this journey, they have to be ready for it. They have to think about all the perspectives in terms of income, cash flows, how to fund it, how to distinguish between parent cash flows and project cash flows. They also need to think about decision making factors in terms of choice of market, the policy impact, the exchange rate fluctuation, the sale value. So, all of this in summary, are factors that lead to complexities when a company is deciding to start their multinational capital budgeting journey. Now, this is essentially a very summary based slide. This question gives you what indicators should the firm look at when they are looking at a project? How does the company decide whether the project is worth taking up or not, right? So there are some indicators that have been looked at. Indicators are the risk adjusted return should be greater than the locally based competitors. Now, remember, any of these indicators can hold true. It doesn't have to be all three, right? You should be also trying to earn superior returns or more returns on foreign projects, right? Foreign projects compared to domestic projects. It's almost a given that your baseline for this journey has to be more returns or a prospective growth. And finally, you have to look at the NPV. The NPV must be positive from both the project and the parent viewpoint, right? So, our analysis or our application essentially is going to be limited to the third point versus the due diligence part. Companies often use either of the two in addition to this analysis, right? So, these are the indicators to decide whether it's a wise decision or not. Now, in the next part, we're going to start discussing the applications of Chapter 18. Hello and welcome to part 2 of your tutorial recording for Chapter 18. So, what we are going to be now looking at is problem 18.4. To begin with, let us look at the details that have been provided for this numerical. So, Brandon Company is considering investing in Venezuelan Bolivar in Venezuela to build a wholly owned haute couture plant to export globally, right? So, they are looking at investing in a factory that will be supporting um, very unique clothing garments. Couture essentially means that, and they are estimating that after 5 years, the subsidiary is going to be sold to some prospective investor based in Venezuela for double of what they are investing, right? So they're going to be expecting a double or an incremental value on their sale. So this can be termed as terminal value, sale value, or salvage value. Now, the pro forma has also been designed, so it's a projective pro forma that the company is hoping that with this amount of sale and expenses, this is the annual cash flow that they will get. They are expecting the same amount of cash flows to be coming in, right? So for a sale of 15 million less operating expenses, this is the gross income. So this is essentially a pro forma income statement where you add back the depreciation to get your annual cash flows. These are all future value based. So you will, in a sense, have to look at the present value. It's ahead in time. They're estimating it, which is why I said it's a projective cash flow. So, what is important to continue to look at is the initial investment is going to be made on 31st December in 2014, and the cash flows will occur at the end of the year, similar time every year, every succeeding year, up to 5 years, right? And they are going to be sending back 75% of the annual accounting income to branded companies. So this is what they will be sending back. This is the remittance or the returns that they are going to be looking at. The tax rate in Italy, very important, is 20%, the home market where the parent is based, and the host market where the project is going to be based is 35%. So obviously the home market is a lower corporate tax rate than the host market. Because the Venezuelan tax rate is greater than the Italian tax rate, very important, please continue paying attention. The annual dividends paid to the parent entity will not be subject to any additional taxes, right? Because the foreign market or the host market, you're already paying a much higher percentage. The Italian government recognizes that differential and they will not charge any additional taxes on your foreign remittance, right? The weighted average cost of capital for the parent entity is 18% on domestic investments, but they add up, top up 8%, so 18 plus 8 for the Venezuelan investment because of the higher risk factor. So they kind of up their threshold for costs and they must be able to get a positive NPV even after increasing their threshold by 8%. So they should get a positive NPV even when they have increased their threshold by 8%. Only if they get a positive NPV will they go ahead with the investment. If it doesn't come true, if it gives you a negative value, then they will go against it. The possible reasons for increasing this top up is exchange rate fluctuation, any changes in your borrowing, any additional remittance restrictions. So they're trying to account for uncertain factors and the additional risk that comes with investing in the new market. Clearly, it's been mentioned what is the net present value and the internal rate of return on this investment. Problem is very simple to do because the pro forma has already been provided for you. So you will start by copying the pro forma as is for 5 years, right? 1, 2, 3, 4, and 5. Exactly what has been given to you in your numerical. After doing that, when you have gotten your cash flows, right, you have been given the pro forma up to this point. You must take into account the initial investment because it's an outflow. And the pro forma does not include the initial investment because it's essentially an income statement. Its starting point is revenue, sale times volume. You also take into account your sale value or terminal value, which is going to be an inflow. So very important line items to be included in your pro forma before you can start calculating your NPV. So in any timeline, like I've mentioned in the previous tutorials, you must account for all outflows and all inflows. Okay. Then you look at your cash flows for discounting. Your present value will not be given in your PV table in this case, so please remember to use the formula. 1 divided by 1 plus r to the power n, which essentially means 1 plus 0.26 to the power 1. 1 plus 0.26 to the power 2, and so on. You could do this by using your calculator and don't round it off to get these values directly. So you just write this down in your pro forma and continue calculating to get a more accurate discount rate. Then in order to find your PV, we've done this a few times. Your future value is always a compounded value, and your present value is a discounted value based on the time value principle. So essentially, when you have your future values given to you, in order to find the present values, you will have to discount, right? 1 plus r to the power n. So have a go at this and see what values are you getting. So based on my calculation, because I've already calculated the 1 divided by 1 plus r to the power n, in order to get your PV, you just calculate your future value times your discount factor. So in other words, there are two ways to calculate this. Either you could take this value, the future cash flow, divided by 1 plus 0.26 in order to get this, or if you've already calculated the discount factor, which I recommend you do because sometimes doing the two steps together might give you an incorrect value, you will get 5375000 times the first discount factor 0.7937 equal to this value. Okay. Similarly, 5375 times this discount factor will give you the second year's value, and so on. So this is essentially how we get the present value of the cash flow. Then you add it all up to get your NPV. If you add up all of the present values, you'll end up with the cash flow amount of 6760200. That's your NPV, which is a positive value. We already have covered how to calculate the IRR. We will have to get a positive NPV and a negative NPV in order to find the IRR. The IRR for this project is going to be 36.62. Now comes the parent viewpoint. In order to calculate the parent viewpoint, we will first have to go back and look at the net income from your project. 75% of your net income has to be contributed or remitted back to the parent entity, which in other words is going to be 4875 times 0.75, which equals to your dividend remittance. Okay, then we go on to find the sale value, which is your income. We will then find the net present cash flows, or net cash flows, not present. Apply the exchange rate, which has already been given in the numerical, and continue to find your calculations. So in order to calculate the application of exchange rate is going to be important. In other words, 3656250 is in Venezuelan bolivar. The exchange rate is 7.1 Venezuelan bolivar by euros. In order to get it in euro, your left hand side, you will have to divide it. Okay, have a go at this and see what value are you getting. It gives me 514964.78, which has been approximated and rounded off in this case. The same present value factors can be used again, which you've already calculated in your project viewpoint. In order to, so these are the future values. In order to get your present value, you will take 1514965 times 0.7937. Okay, so this is how. Try and do each column first so it's easier. After you've calculated your dividends, incorporated your terminal value or sale value, you will find your net cash flows. You will then have to convert it back to the parent entity's home currency, which is why we are looking at future value of cash flows in euros. So that's the main difference between this line and this line. We're looking at the parent viewpoint here. We will again follow the last few steps the same way. We will apply the exchange rate, we will find the future value, and then look at the net present value, the sum of all PV of cash flows. Okay. This again shows us that the NPV is positive. In other words, the conclusion is it's worth taking up the project because both the project and the parent viewpoint is a positive value. Okay, so have a go at completing this, and I hope that you will be able to find the same answers and be able to make conclusive remarks after having calculated the numerical. Hello and welcome everyone. Today we're recording tutorials for chapter 18. So what we are going to be now discussing is another type of application where we will see how multinational capital budgeting is instrumental for companies to make strategic business decisions. So Carloco Carpets, Germany manufactures high-grade textiles, and until very recently, they used to subcontract to other companies because they wanted to ensure that quality was maintained, and they wanted to make sure that the manufacturing base was in the Middle East itself. Now, after having analyzed options with regard to the subcontracting agreements, they've shortlisted two possible locations. Okay, so the first location is Cairo in Egypt, and the second one is Amman in Jordan. So at the moment, the following expected after tax cash flows have been provided as indicated below. Although mostly the operating outflows would be in Egyptian pounds, okay, or Jordanian dinars, because these are the two markets they're looking at for subcontracting. Some additional euro cash outflows would be necessary as mentioned. Okay, so this is a unique type of summary with regard to cash flow statement where both types of currencies are expressed. For the one in Cairo, the two line items are one in Egyptian pounds and the other one is additional euro cash flows. And the cash flow statement for Jordan, Amman, is indicated in dinar cash flow and also additional euro cash flows. Okay. Now, of course, the operating cash flows for Cairo and Amman have a mix of inflows and outflows. As you can see, the negative values are outflows. And as has been mentioned, additional euro outflows would be necessary, additional working capital possibly. So the euro outflows are all of negative value. So then let's look at more details. First, what's relevant to see is the exchange rate between Egyptian pound and euro. For 1 unit of euro, the Egyptian pound exchange rate is 8.4. For Jordanian dinar, it's 0.78 for 1 unit of euro. Carloco expects, so he's also, the company, it is also expecting essentially an exchange rate movement, the pound to appreciate by 5% every year against the euro. So the Egyptian pound is going to appreciate, meaning every year for the same 1 unit of euro, the Egyptian pound has to give lesser exchange value because they are appreciating. And the Jordanian dinar to depreciate by 3% every year. The weighted average cost of capital is 22%. So what Carloco wants to do is to understand whether they should set up the base in Cairo or should they set up the base in Amman, right? So they're trying to find the location suitability based on this evaluation. Now, what's important to note is the number of years have not been mentioned directly. However, it has been implied in this timeline given. So there's going to be a year 0, 1, 2, 3, 4, and 5. So the project expects to be running until 5 years. So what is important is your exchange rate movement also has to continue to appreciate in case of Egyptian pound every year all the way up to 5 years and Jordanian dinar to depreciate by 3% all the way up to 5 years again. It's a fairly simple pro forma. Pro forma is going to be based on what has been provided 2019, 20, 21, all the way up to 24. Your 0, 1, 2, 3, 4, and 5. I am going to list the Egyptian pound cash flows, the inflow and the outflow respectively. The exchange rate movement. So this is what you have to calculate. This formula will also be provided in your formula table. So in case of an appreciation, the formula is foreign exchange rate divided by 1 plus R. The rate of appreciation is 5%. So every year I'm expecting that I'll have to give about 5% fewer exchange with regard to euros. So 1 plus 0.05. So have a go at this. It's going to be a cumulative calculation, right? 7.619 divided by 1.05. So keep your calculators ready and keep dividing by 1.05, right? In order to get the subsequent values. Again, for the fourth year, it will be 7 point. So you will have to list this amount down, and on your calculator, you can just continue to divide by 1.05 to get your values. So you don't necessarily have to do this step of showing how you're getting these values. You just have to list it. For the purpose of your understanding, I'm writing it out for you guys. After you've listed the exchange rate movement, you're going to apply the exchange rate. So you are essentially looking for euro, which is your left hand side. Your Egyptian pound cash flows is already given here. Your exchange rate is denoted as Egyptian pound by euro. So you're going to divide it to get your left hand side. So essentially it is going to be 10,000 divided by 8 to give you 1250. This will be negative 15,000 divided by 8.4 to give you negative 1786. So have a go at this to see the cash flows in euro. Then you add any additional euro cash flows that have been mentioned. In this case, it's all outflows. So that has to be implemented to get your net total cash flows. So this essentially is where you look at totaling up. Your WACC has already been mentioned as 22%. So you will be looking at 1 divided by 1 plus R to the power n again, which in other words means 1 divided by 1 plus 0.22 to the power 1. 1 divided by 1.22 to the power 2, and so on subsequently. Remember what we did in problem 18.4? These are all future cash flows. You're essentially looking at the present value. So in order to look at the present value, you'll have to discount your future cash flows. Because I'm already dividing 1 plus R to the power of n in the discount rate factor, I could also write this formula like that. So I'm going to be multiplying your future cash flows times 0.8197. 876 times 0.6719. 1040 times 0.5507 should give you this value. Okay. Then when you add it all up, it will be giving you a positive cash flow. So far, I understand that the Egyptian subcontracting project makes sense for Carloco because they get a positive NPV value. You will have to try to calculate the IRR the same way by taking a positive NPV and a negative NPV value. Now, please conduct the same steps with regard to pro forma, For the Jordanian project, it will be year 0, 1, 2, 3, 4, and 5. The company is expecting a different exchange rate movement. So the first line item will be to list the Jordanian dinar cash flows, inflow, outflow mixed. The company is expecting the Jordanian dinar to depreciate in value. So every year you'll have to pay more to get the same 1 unit of euros. So in order to do that, you will again have the same formula for depreciation, which is FX, foreign exchange rate, divided by 1.03, 1 minus R, okay? 3% depreciation. So 78.78 divided by 1 minus 0.03. 0.80 divided by 1 minus 0.03. 0.83 divided by 1 minus 0.03. So the best way to keep your values accurate will be to keep taking your numerator and adding up your denominator for each column. So these are your columns year-wise to get these values. Once you have the exchange rate movement, you will have to apply the exchange rate. So you need, left hand side is euros. You have Jordanian cash flows. Your exchange rate is Jordanian dollars per euro. You divide the same to get this value. So 5,000 divided by 0.78, 4,000 divided by 0.80, and so on. You will also have to incorporate the additional euro cash outflow line item, adjust the same. You need not calculate this again. Recalculation is not required. You can just plug in the values as is and apply the same approach. Your future cash flows times the discount factor will give you, the discount factor is 1 divided by 1 plus r to the power n, right? Will give you the present value. You sum it up to get again a positive NPV. Well, of course, even without looking at the IRR, you can make a conclusion that Carloco should pick Jordan as the main location for subcontracting because it has a higher NPV. So not only are both the projects a positive amount, but the Jordanian location gives you a much higher value. So this is a unique distinction between what we looked at in 18.4. In this problem, you get both the situations giving you a positive NPV. In that case, how do you make an adequate capital budgeting decision? You essentially go with an option or go with the choice that gives you a higher value of NPV. So have a go at completing both the numericals and looking at these values. The key distinction is the exchange rate movement integrated in the multinational capital budgeting numerical. And we'll continue in the next part. Welcome to part 4 of our tutorial recording. So we're going to be looking at problem 18.6 now. In problem 18.6, Scott Organic Company is considering investing in Romania to understand how they can manage their transportation cost. Now, the initial investment amount is going to be Romanian leu, 62.5 million or 10 million pound. The cross rate has been given as 6.25 RON per pound. They will also have to incur or account for an additional working capital of 25 million RON. Okay, so these are the three details that we looked at. They're looking at the project running up to year 0 from 1, 2, and ending in year 3. All the income is going to be repatriated. So this is going to be the returns for the parent pro forma. Okay, for the parent cash flow statement, you will have to start with the entire net income as your starting value. Now this numerical doesn't have your income statement given to you. You'll have to construct it. Okay, how you will have to construct, for example, is for your demand per unit and sales price per unit has to be multiplied in order to get your revenue, right? You'll have your less operating expenses, depreciation, and initial investment amount. The British pound forecast. So because they have given everything in British pound worth, we are going to calculate the project viewpoint in pound denomination as well. So this is an important tip for you to take note of. If the company has mentioned all of the details in British pound worth, which is their home currency worth, and not everything in the host currency denomination, then we will have to calculate the project viewpoint in pound worth. Now moving on, the sales value is given at 12.5 million. The variable cost is 75% of sales. So that's something that you'll have to calculate. The Romanian tax rate, the project tax is 20%, the Scottish tax rate is 25%. Both countries allow a tax credit paid in other countries. The WACC is 15%. You are expected to clearly show the difference in tax calculation paid in the foreign market. You are also expected to create the project pro forma in the home currency denomination for Scottish Organic. So I'm going to begin by looking at the project viewpoint. My initial investment has already been given as an outflow of £10 million. My revenue will be calculated based on demand times sales price per unit, less cost of manufacturing, which is 75% off your sale. So in other words, it'll be 450,000 times 0.75 should give you this value, right? Times 0.75 should give you the second value. You will then get your gross profit, take away your fixed operating expenses. This has also been given. Your depreciation has been given. That will give you your earnings before tax. 20% on EBT will give you your earnings after tax or profit after tax or net income. So this pro forma is something that you'll have to remember. Add back your depreciation, your working capital, if any, your sale or terminal value. So it's all about remembering how to create the income statement and constructing it. In this case, you will see that the NPV is a negative value, which tells me that it's not a lucrative project. Either the parent or the project viewpoint, if they have a negative NPV value, that means you don't go ahead with this decision. However, we must calculate both the viewpoints and then provide our conclusion. I hope you remember how to calculate your present value factor, 1 divided by R to the power n, where R is 1 divided by 1.15 to the power 1 for the year, 1 divided by 1.15 to the power 2, 1 divided by 1.15 to the power 3. This is your future value. In order to get your present value, you will have to take your future value times 1 divided by 1 plus r to the power n, right? So that's how you get it. Adding it all up, sum will give you your NPV. So have a go at the project viewpoint. I'm sure you'll be able to calculate it up to this point. We need not calculate the IRR because we already know that the NPV is of a negative value. Now moving on, for the parent viewpoint, I'm going to start with the income statement. They've mentioned that 100% of the net income, which is this line item, is going to be sent back. So that's what I will begin with. Is going to be sent back. Now you will have to show clear tax calculations. So you'll have to add back foreign taxes to get your grossed up dividend. Then take away your home market tax. Then you take away the foreign taxes paid in order to find the difference. Now the difference suggests that your foreign market, right, you only paid for, if you go back to the project viewpoint, you only paid for 20%, and in your home market you have a 25%, right? So that's what you will essentially be adjusting for. So you will be looking at the difference between what you've paid in the foreign market and what you've paid in the home market. Okay, so this value and this value is what is going to be adjusted for. So what you are doing is you're looking at your home market taxes 875 and your foreign market taxes to find your differences. This is for year 1. For the second year, again, home market taxes is 67969 minus foreign market taxes to get this value. And for the third year, your home market take away your foreign market. So you notice that you will have a negative value because of the difference in the tax rates. Then you will calculate your cash dividend, which in other words is going to be 230, your income that you're sending back, 230,000 minus 14,375, the difference in the taxes. So in other words, you are looking at the remittance value and the difference in the tax rates between the two markets. For the second year, you will look at 217,500, the net income, take away your tax difference. This is in a way the tax that you're due to pay, right? The tax that you're due to pay because of the difference in the tax. For the third year, it will again be 210 minus 13,125. So have a go at this and see how you're getting the cash dividend. Cash dividend less added Scottish taxes. Added Scottish taxes because your foreign market tax is lower than your home market. In that case, the incremental, the 5% difference has to be adjusted for, which is why the numerical asks you clearly to show all the tax differences. You can again calculate the present value discount rate or just write it down as is from your project viewpoint to save time. Find the PV and add it all up to get your NPV. The conclusion indicates that both the project and the parent viewpoint have a negative NPV, hence this project needs to be scrapped. Okay, so what's unique about problem 18.6 is few things. First is the tax implication. how should the multinational project, multinational capital budgeting, account for tax implication if the foreign market has a lower tax rate than the home market? So that's the first unique thing about this numerical. The second unique thing is the project viewpoint is calculated in the home denomination or the home currency. Okay, so there is very limited scope for exchange rate implication here. We're just starting off with pound denomination calculations and continuing the journey. So I hope you've been able to learn something from both your lecture pre-recordings and your tutorial pre-recordings for chapter 18. And good luck and see you next time. Thank you for listening.